Welcome, everyone. Thank you for being here and joining us today. We're going to start right on time. And if you hop in a little later, that's okay. We've got a recording for you as well. So we're going to get going with some options trading. We're going to look at how to use automation and algorithms to help you do some of the heavy lifting with what can otherwise be sort of complex. So we'll look at one-touch responsive trade alerts. That's a really great feature that people enjoy using. We'll look at automation on these pre-built option spreads, and then also how to automatically manage your risk and your profit, and really using this type of approach and strategy in any market condition. And then to kind of bring it all together, we are real people, so we'll be here to coach you and help you along the way. I encourage you to ask any questions and use the chat commentary there during the presentation. I'll have a chance at the end for some Q&A. All right, so with that said, we'll go ahead and get started. Remember, we're speculating, and that means there's always risk involved when we're trying to generate a profit. So do take a moment and look at the risk disclosure there. The main thing to keep in mind is that there is always risk of loss when trading and speculating. You should only use risk capital, and that past performance is never a guarantee of future results. So feel free to take a screenshot of that if you'd like to read all that in detail. All right, a little bit about AltaVest. We are a registered introducing brokerage firm, and we've been around since 1997, and we developed this proprietary options trading technology that we're going to demonstrate and review for you today. And we've traded millions of futures and options contracts along the way. And we're registered with the Commodity Futures Trading Commission and also a member of the National Futures Association. And we're located in California. And I'm Eric Gebhardt. I have a BS in Business Administration from USC. I'm a co-founder of AltaVest. I've had a few securities licenses in the past, Series 6, Series 63, and insurance and so forth. Currently have my Series 3 commodity futures license, as well as the Series 65, that's for investment advisors. And then maybe you've seen us before. We do lots of these presentations in different venues, so perhaps you've seen some of our other webinars. And if not, thanks for joining us today if it's your first time. And then maybe you've seen us in the financial press. We sometimes get quoted in some of these periodicals, such as Market Watch. Here's a little article here on gold reaching out to us, and my partner here, Mike Armbruster, commented, and they gave us a nice shout out in that article. All right, so very good. So we'll go ahead and kind of get into the meat and potatoes here of the presentation. So over the years, we've identified these three barriers that seem to be a common denominator among clients. They seem to think these are the things that get in the way of their success. There we go. Number one is information overload, essentially noise, lots of conflicting prices, opinions, narrative, and what you might call clickbait headlines. And here's a piece called Information Overload in Trading. I thought this was appropriate and quite relevant to what we're talking about. So the number one cause here, or a cause, would be overloading the number of sources you're getting your information from. Then how about the complexity of all that information? Can be quite challenging. And then how about the lack of filters? How do you know what to identify as what's important and what is not? So how do you filter out the good from the bad? So what's that impact look like? What does all that mean for us? Well, we can end up with analysis paralysis, where we're trying to analyze these overwhelming amounts of data, and then that can decrease the quality of our decision. We can lose focus on what really matters and what the key factors are in helping make a worthwhile decision. And that develops fatigue and stress along the way. That mental fatigue is something I think we can kind of relate to, like this gentleman here in the photo. So there are ways to combat that information overload. How about prioritization, focused analysis, and then how about this use of data filtering tools such as automated data analysis and algorithms? And so we're going to talk a bit about that in the demo. And then how about delegate and consult? So involve experts or specialists in your trading endeavors. So I think that's something that we can help you a lot with. We can bring you technology and our expert analysis as well. But you don't want to end up like this guy here, struggling to make a move because of too much info. And then how about number two? The second barrier here would be time and discipline needed to screen watch. So not many people have time for this. It looks great, sort of an idealistic version or vision of what some of us have in mind as to how we should be trading, but it's not really practical for almost the majority of people that have a full-time life to live. Here's a person that spends 10 hours a day trading, and when the market's open, and they spend another 4 to 5 hours actively trading. So then you're spending hours before and after that as well. And of course, if you're day trading and it's working well for you, then certainly keep it up. But again, it's not really a realistic approach for most of us. And here's the third barrier: us. We become our own worst enemy. As humans, we, of course, have emotions, fear and greed. We ride that emotional roller coaster. So you can see the optimism here as you're probably doing well. And then as things aren't doing so well, maybe you're giving some money back, you start to panic. You might wave a white flag of surrender. And then that cycle repeats itself. But that's a tough cycle to be on. We want to try to stay off of that roller coaster and control our emotions. And it's difficult to control emotions in an ever increasing algo driven landscape, that's for sure. AI and algorithms are quite dominant. 60 to 70%, 75% of overall trading volume in the US equity market, European markets, Asian capital markets, so forth, are generated through algorithmic trading. And that was in 2018. I have a more recent quote. I believe it was 80 to 90%. JP Morgan suggested that US equity trading. So, this is your competition right here, folks. Something like this: no emotion, automation, built-in risk and reward controls. They have mandates they're running with and using machines to execute. So that's automation. And if you aren't using it, I think you're doing it all wrong. So can automation work with professional option strategies, help us defeat those barriers we looked at? We think the answer is yes. And before we look at our demo, just a real brief review of a couple key concepts with options trading. I'm sure most of you already know this. Of course, you have put options and you have call options. Now, put options represent the right to sell something, and call options represent the right to buy something. And keep in mind, you can be a buyer or a seller of an option, whether it's a put or a call. So the buyer is said to be long an option, will then pay a premium. And who do they pay the premium to? To the seller. And the seller then collects that premium. And that could be for puts or calls. So the seller is selling the option, and they go short the option, and they collect the premium from the buyer. And again, that's whether it's a put or a call. It doesn't make any difference. So you can be on either side of that transaction. And there's a real basic strategy in if you're trading options. You could, if you're bullish, maybe you just buy a call option. In this example here, maybe you think the market's going to keep moving higher, and so you buy a call option and hope to profit that way. Or if you're bearish, you think the market's going to drop, you might simply just buy a put option. But those are called long option strategies, because you're buying a call or you're buying a put, and you pay premium for that. regardless of your outlook on which direction you think the market is headed. Now, there are short option strategies as well, and kind of a distinction here is a lot of short option strategies can be non-directional or neutral, and you don't really have to have let's just say, a conviction in terms of market direction. You don't have to be exceedingly bullish or bearish. Here's an example: the market moving sideways over a period of time, and you might have a non-directional strategy that can benefit if the market stays within that range. So we're going to talk a bit about that. And then, of course, you can also collect premium in a bull market or bear market by simply, you could sell out of the money puts here, or you could sell out of the money calls and collect premium, or it could do it as a spread, and that's what we're going to get into. But first, we need to learn two Greek letters. Delta is the first, and that helps determine probabilities. And it represents, or actually the formal definition is, how much does the option value change with the change in the underlying index or asset. And option traders look at it as the approximate probability of that option expiring in the money. So here's an example. If a delta is 0.25, that means there's a 25% odds of that expiring in the money, but also what it means, there's a 75% chance that it would expire worthless in this example. And of course, delta is a number that's always fluctuating. It's not static. It doesn't remain in place, remain the same. And it is not the probability of a winning trade. So keep that in mind as well. And now here's the other Greek letter, theta. It just represents sensitivity to time. Remember, options have limited life. They all expire at some point. It's called a wasting or a decaying asset. And theta is a negative number. It equals 1 day of time decay. So here's what it looks like on a graph. You'll see as time on the option starts getting closer and closer to zero, the percent of the value or premium in that option drops and drops and drops. And eventually it ends up with 0 days till expiration, or zero time value. So that's really what theta looks like, and how you can kind of represent that on a chart. And here's a good little piece I ran across. So top 10 reasons why selling options is better than buying options. We're not going to go over every single one of them, but there's a few highlights here. They talk about being professional. It says managing risk like a professional. The professional approach distinguishes option sellers from novice speculators. And they talk about long-term growth. Selling options, it says here, the strategy is often preferred by long-term investors who value consistency over high-risk speculation. Then I was asking ChatGPT. I figured, well, we're talking about automation and algos and AI. So let's take a look at what ChatGPT has to say. I asked, why do professionals sell options instead of buying options? They talk about the time decay advantage. So remember, we just talked about that with theta decay. They mention the higher probability of profit because the seller receives the premium up front. And they mention income generation, and then market neutrality. We mentioned that briefly. Selling options, traders can use strategies that can benefit in a sideways market. And to summarize, it says here, these advantages make selling options a preferred strategy for many professionals. So why don't we try to trade like a professional? That's what we'd like to do. And the Wall Street pros are doing option spreads to collect premium. And so we're going to look at some visualizations here, look at some graphs. So what am I talking about here? How do you collect premium with an option spread? Here's a simple example where you sell an out of the money call spread. So the red line is the call you sell. You collect premium for that. And with some of that, you buy an out of the money call spread at a higher strike price as protection or a hedge against that position moving against you. You don't want to be naked or short naked these options, or uncovered, I should say. So here's what that looks like. You sell this out of the money call spread, collect the premium on a net basis, and then you look for the market to kind of chop around or maybe go down, or you can even move a little higher and it wouldn't really matter. You can see the expiration date, and we do place these trades and get out before expiration. Maybe we try to get out of these usually within, oh, I don't know, half the time before it expires. And I'll give you some more details, but you can see, how do we get out of them? Well, let's look up here at the graph. You see this big blue arrow pointing to this area here, and that's October 8. And you can see here, October 8, there's a signal here, a blue bar, or a blue square, I should say. And that's called the risk thermal indicator. That's our color-coded system of identifying when to get out of a trade, or when to cover the trade for too much risk or too much profit. In this case, it says take a profit. You've made enough money on the trade, and move on to something else. And the key thing here is this can be automated, so that when you have a signal like this, you don't have to watch your screen. ThetaTrader, our program, I'll show you that in a second, will then place that order for you automatically. We'll show you how to do that. But you can see the expiration date here. So this trade gets closed out. So just to kind of go back in time, you sold the trade, collected the premium, and then you buy it back at this point here, and the net difference, you sell high and you buy low. That's the whole idea. Here's another strategy called an iron condor. It's non-directional, and it's the same thing as what we just looked at with selling an out of the money call spread, but you simultaneously sell an out of the money put spread. And you don't leg in, you do this as one order simultaneously, and the net result is you collect premium, and you look for the market to stay within that range between those black arrows, just like in that example here. And even if the market ran higher, at the same time, you're losing time. So even a strategy like this can do well if the market moves in a particular direction, and say in this case up, or even started to drop a bit. And we'll show you more in just a minute. Then we have a dragonfly. That's our proprietary strategy, and it's a non-directional strategy, and it collects premium. Then it's really a variation of the iron condor strategy, and we're going to look at some demonstration here in just a brief second. So here's what it looks like on the graph. You're selling this out of the money call spread and out of the money put spread, and collecting premium on both sides of that transaction. And you notice here that there are 3 calls that you're trading, and then there are 3 puts that you're trading. And you can see the market trading here. And let's look at how we close out that position here. So again, you place the trade, the market starts to move sideways, down, up, it doesn't really matter, but you get a signal to buy back that spread and cover that spread right here with 12 days till expiration. You can see the expiration date here. So you close out the trade, you take your winnings and move on to a different trade. And that's the whole idea, to sell high and then buy it back lower at a future date. So rookies mostly do this type of thing when they're trading options. There's a good little video I ran across a couple years ago. It's still quite valid. It's not really outdated at all, but talking about why this popular trading strategy is so risky. So what strategy are they talking about? Well, it says a majority of small-time traders are buying the most basic call and put options, which have a much lower probability of profit versus advanced strategies like option spreads. So basically, a rookie is just going to buy a call or buy a put, and that's all they're going to do. They're not going to get involved with option spreads, certainly not getting involved with selling options and being short an option spread and collecting premium. And it says here, John Foley, CEO of Options AI, comments, everybody in the business knows that if you're only buying out of the money calls, then you're likely going to lose money over time. So we don't want to do that. We don't want to just stick with only buying calls or only buying puts. We want to trade like professionals. We want to learn how to sell options to collect premium. We can use technology and algorithms to do that, and that's called ThetaTrader. That's our software that we developed with pre-built option strategies. And these proprietary algorithms are called theta trades. I'm sorry, the proprietary algo creates what we call theta trades each daily, providing a menu of opportunity Then we have these one-touch responsive trade alerts. You're going to love seeing that too. These are integrated. You just touch your screen and that's all you have to do. Any market condition, bull, bear, neutral, flat market conditions, automation with risk and profit tracking. And that's called the RTI, or the risk thermal indicator. And that's color coded. Okay, so we're going to jump into a demo here. Just give me a brief moment to switch screens if you don't mind. All right, now you're looking at the dashboard. You can see the ThetaTrader dashboard. And what I'll do is we're going to run through some demo trades and some simulators and so forth. So it'll be kind of exciting. I think you'll have a good time with that. All right, so here we go with, you see active trade alerts up here. You see the theta trade section here. Then you see our open short or sold positions here, and then any open long or bought positions. You notice to the right, this is your account info. This is integrated directly with your AltaVest trading account. And we'll go ahead and look at some examples here of the theta trades. You'll see there are bullish strategies, there are bearish, and of course non-directional strategies. These are all pre-populated, and we're looking at 3 different markets, and we'll show you why in further detail a little bit later. But suffice it to say, this is where all the volume and liquidity is. On the E-mini S&P 500, the E-mini NASDAQ 100, and the E-mini Russell 2000. So that's our focus. We're trading the index because of liquidity, the execution, and also an index is less volatile than any particular individual stock. And that's really a great environment for a lot of these premium collection strategies. So what we can do is, let's look at an example of a dragonfly on the E-mini S&P 500. You'll see there are dragonflies available anywhere from 33 to 58 days till expiration. And those are generated by the algorithm. The strike prices are pre-selected. The expirations are selected. The values and the target and so forth is pre-selected. So this is called the targeted annualized return. You can compare one trade to another with that. This is your maximum profit potential at expiration, assuming you took it till expiration, which we don't suggest you do, but it's there anyway if you want to look at that. But let's click on this and drill down and look at the details. And you should be able to see my screen. I've magnified it here, so just give it a second here. Okay, so now first thing I like to do is look at a graph, or here's a chart. And the dragonfly structure, we kind of looked at it briefly, but let me drill down in some of the details. You sell 4 calls, you buy 3 further out of the money calls, and then 1 closer to the money. And then with the same structure on the puts, you sell 4 puts, you buy 3 further out of the money, and then 1 closer to the money. So for every short option, you are long an option or completely covered. These are all covered strategies, so you do not have unlimited risk. Your risk is predefined before you place that trade. And you can see the expiration date here is that purple line. But here's where the market's trading right now. So here's the upper boundary of the trade, 74.25 strike, and the lower boundary, 61.75 strike. And again, the algorithm will determine which options you're going to trade, and it's not always going to be, say, a 50-point spread between the strikes. It could be different depending on market conditions. And the benefit here to the dragonfly is you own this call that is, in this case, 50 points closer to the money compared to the 4 you sell. And that delta is higher, so it will react more quickly and gain in value more rapidly, and lose time value or lose theta decay less rapidly. So you own that call, and it acts as a little bit of additional layer of insurance or protection against the 4 that you've sold. And the same thing with the put if the market happened to drop. So that's the benefit and the difference and the distinction, I guess you could say, between the dragonfly and the condor, is really this extra bit of insurance that you buy here and here. It does limit your profit potential a bit compared to a condor, but at the same time, it can create a more robust trade. And we'll look at some of the details in a simulation here. But let's see here. Excuse me, I had a frog in my throat. You've got the put risk, the call risk, the commission, the available capital, the cash required, profit potential, targeted return on cash, targeted annualized return. But here's the thing to look at. Let me drill down here. So you've got $4,644 is the cash required for this particular trade. And you might think, well, why would I allocate that much money to this one trade? Because my profit potential is, quite a bit lower. Well, the reason why, and let's look at the key here, we're looking at these higher probability outcomes by selling these out of the money puts and calls. So the 4 puts that you sell, the 61.75 strike price, they have a delta of 9.55. So that means there's over a 90% probability that these options you're selling to someone else will eventually expire out of the money. And now look at the calls, 74.25, 6.99 delta. So 93% probability, according to the delta, that these calls you're selling to someone else will expire out of the money. So that's kind of the idea behind these strategies here, is where you're seeking to generate lots of base hits. Any one of these trades is not going to generate a grand slam, so to speak. So this is more of a slow and steady approach, more of a consistent approach, a higher probability approach to trading options. So we're looking at these spreads to collect premium. You see the quantity always defaults to 1. You can raise it or lower it. You can see the cash required moving up and down. For the sake of the demo here, we'll just do 2. The value is all pre-selected for you. You could change it. You could try to get a higher number if you'd like, sell it for a higher price. And you could change any of these strikes if you wanted, but I wouldn't recommend it, but that's up to you. And you simply then, if you want to place that trade, you go ahead and place it. And you can see here, we just sold 2, and the demo account just assumes we're filled. Again, this is just a demo account for these kinds of presentations. All right, so we'll go back, and you'll notice there's a trade alert here. We're going to look at that in a second. But before we do, I want to show you the trade simulator right here. And let me squeeze this down. There, you should be able to see. Okay, so here's a trade from October 8. Had 31 days till expiration. It's a week 1 iron condor. And we're just going to demonstrate a condor versus a dragonfly and some of the character traits between the 2 strategies. One isn't always better or worse than the other, but we do like the dragonfly a lot, and we'll show you why. But you can use these buttons down here to go and play the scenario out and see how the trade would have performed. You can go backwards, you can go forwards, you can go all the way to the back, you can go all the way to the end, but let's just play it and I'll explain what's happening here. You can see the green RTI, that means good, do nothing. You can see the P&L on the trade is still negative. That's simply because theta decay hasn't had a chance to really work yet. It's not losing enough time yet to really make the trade, and now it's turning profitable. Okay, so it's starting to move higher. It moved lower first, then it moved higher. And this very typical type of trading action here for sure. And then look, you get a blue profit taking signal right here. So with 9 days remaining, you have a blue profit taking signal, and ThetaTrader says that's enough money out of this trade. Take your money and move on. So that trade did just fine. And now remember, that's the week 1 November iron condor. So what would happen if for the week 1 November expiration, instead of doing an iron condor, you did a dragonfly? Well, let's compare. You can see a yellow RTI, which means slightly elevated risk, but still don't do anything. At this point, you're not doing anything. You're just day by day is going on and the trade is just maturing and you're not doing anything at all. You're not having to make any moves or anything. You don't have to touch a thing. Then look at this. You get a profit taking signal with 15 days remaining on this dragonfly. So this is the algorithm saying the trade has matured and get out, take your profit, basically buy the trade back, cover the position and move on to something else. So that happened with 15 days till expiration, compared to the condor here. You had to stay in that trade until there were 9 days till expiration. So almost a week longer you had to sit on the iron condor trade before it matured compared to the dragonfly. So that's one big reason and factor as to why we like the dragonfly. It can mature more quickly and allow you to get out of that position and move on to something else earlier compared to a condor. Now here's another condor versus dragonfly example. We're going to go ahead and look at this here. I'm not sure I recall exactly what happens. Okay, here we go. You see it turns yellow and orange. So more elevated risk, but still don't do anything yet. ThetaTrader says don't do anything. And then finally, the market moves too far, too fast, the wrong direction, and you get a red RTI. And that means too much risk. That means you've lost too much money on the trade. And to cover the loss and move on to the next trade. So of course, when you're trading, you're going to have some losers. No way around that. But whenever it turns blue, I showed you that's a profit, and you can automate that, and I'll show you how to do that. But also when it turns red, you can automate that as well. So regardless of whatever happens, whether it turns blue or red, whichever happens first, you'll get out of that position if you automate that and turn on the settings for the automation. And I'll show you how to do that. But remember, this is a losing trade. So that's the September into month May condor. Now here's the dragonfly. Yeah, remember here, that's why I put this September into month, or I'm sorry, the May into month dragonfly. So obviously the same market movement, but you have a different strategy in place. And remember, you own this call option here compared to the 4 that you sold 50 points higher. And you still get that elevated risk just like you saw before. But look at this. You don't have a red RTI because this call option that you own is providing that additional layer or level of insurance, and it's allowing you to stay in that position. And now you're back to a green RTI. And then finally, you get a blue RTI and you take profits on that position. So instead of a losing trade with a condor, had you done a dragonfly on that same day, you would have ended up with a winning position here. So that's why we like the dragonfly. You give up some profit potential, but it can be more robust in certain conditions, just like in that example. All right, so that's a couple of examples there. And now let me show you how to do the automation. So you go under My Account, you go under Settings, and you'll activate the Risk Manager by checking this here. And then you'll notice here you can use red, orange, or a custom level for your Risk Manager. So if you used orange at a 38 risk level, that's okay, but keep in mind you'll have more frequent losing trades, but the losses, the magnitude of the losses will be smaller compared to the 50. So it's just your preference. Or you could use a custom anywhere from 50 down to 25. You could do that too, but for the sake of this demo account, I just keep everything at the default level at 50. And then you would save those settings. And then the same thing with the profit directive here. Okay, so you would check that box and save the settings just like that. So that's how easy it is to automate the management of your position. So once your order is filled, you have a trade on, you don't have to scan anything or monitor anything. ThetaTrader will do it for you based on your instructions here and automatically close out that trade whether it reaches a profit or a risk target, whichever comes first. All right, so here is also an explanation in their help file on the color coding for the risk thermal indicator. It's all right here, and then details on the spreads and so forth. So just wanted to point that out. We're not going to have time to read everything. And then also wanted to point out here under my account as well, you'll notice there's this navigation panel, placing trades, education. But here and here, these are videos, tutorials to really kind of walk you through ThetaTrader and exactly how to place any particular trade and so on and so forth, and how to use all the tools in ThetaTrader. And then this section here is an education section, kind of our master class with futures and options education. And it's not hours and hours and hours of training. It's actually really concise, and it's what you need to know to be able to do this. And it's all right here. These are all video tutorials here for education, and that's kind of included with ThetaTrader if you're a ThetaTrader user. Okay, so I wanted to uh, point that out to you as well. And then let me go back to the page here. So you can see we have this trade alert on the home page. So what you do, if you see a trade alert on your dashboard, now you'll also receive your trade alerts via email and via your phone. But since we're looking at the dashboard, I want to just show you how it works. You'll click that and it'll take you right to the trade alert page. So you'll see an image, a chart of the actual alert. You'll see maybe a description of the trade. So this is clearly a dragonfly position, has 37 days till expiration. And it trades off of the March E-mini S&P 500 contract, futures contract. You can see the strike prices are all designated here. You can see the expiration date here. So here's the current price. So you're selling this spread and this spread here on this dragonfly. And notice the quantity is pre-selected for you. And this is a big deal because every alert you receive is customized and tailored to you and your account. So the size of the trade is appropriate for your account and the account balance you have and the available capital you have. And also the trade itself, you won't receive a redundant trade or position. If you already have a same or similar position, you won't receive the same particular trade as an alert to actually end up with too much of any one position. So the sizing is all pre-generated and custom and tailored to you and your account, but you can also lower the sizing. You can't increase it, but you could lower it. Maybe instead of 8, you want to do 5 of these or 4 of them for whatever reason. But you can see the premium being collected here, cash required being collected, days till expiration. These pop-up windows occur just by hovering your mouse over the numbers. So everything is spelled out, cost of the trade, the cash required, days till expiration, everything here. So we'll go ahead, we'll just do 3 of these to be different, and we'll click accept. And there you go. You see the 3 dragonflies we just placed there. Okay, so that's how you do it on the dashboard for the trade alerts. And then you can also go back in time and you can look at closed positions. So here you go. For example, I just filtered for dragonflies because we've been looking at the dragonfly, but just going back a few months. But look at the last 20 dragonflies on this page here. You've got 20 trades, 18 winners, 2 losers. And the idea of showing this isn't to say you're going to always win with a dragonfly. It's to show you that you've got these higher probability outcomes with something like a dragonfly where you're collecting premium and it's lots of, a bunt or a base hit. That's the whole idea. So yeah, occasionally you're going to have some losses. You might even have a string of losses depending on market conditions. But the whole idea is to have a consistent approach where you're trying to avoid I guess you could say, that rookie mistake of just always buying premium and paying money for a call or a put option or a spread. you want to try to be on the other side of that transaction for the most part. So anyway, just thought I'd point that out. All right, now let me jump over, and I think that's all we're going to cover right now on the dashboard, but I want to show you how the alerts work on your phone. All right, so if you have any comments or questions, feel free to let me know. See, we got a nice crowd here. And let me see if I can jump over. If I can do this correctly. If you've ever tried to operate your own webinars, it can be sort of, well, there's a lot of ways to have the wrong mouse click and kind of ruin everything quickly. So hold on just a moment, folks. Okay, here we go. All right, you are back. We're back in business, cooking with gas here. So we're looking at how to respond to trade alerts in one touch. You don't even need to be on your dashboard. So these alerts, again, these are live and integrated with your AltaVest trading account. And all you have to do is touch accept to place the order. Of course, you could always touch reject, but this is kind of how it would look like. You receive an alert on your phone, just like this. We'll go ahead. You'll get that text message with a link. You touch the link, and then it will take you right to the alert page. You'll have a graph of the alert. Should look somewhat familiar. This happens to be another Dragonfly. You can see it has 66 days till expiration. See the calls here and the puts. See the purple line is the expiration date. Notice the quantity is pre-selected for you. Selling 7 of these at a price of 9.6, trying to collect 27.72. And this is all net, by the way, of the cost of trading. All the commissions and so forth are already factored into everything. So we just changed it to 5 from 7 just because, just want to demonstrate you can always lower the quantity, but you cannot increase the risk. Then you just touch accept. And that's it. That's how easy it is to place a trade. Something that's otherwise very complex to actually create and build and even place on your own. We make it available in one touch. And in fact, I've got obviously brokerage accounts, and I don't know of any brokerage that can do a 6-legged spread, a Dragonfly, in one order at one price, just like we do. So we created our software to be able to do that. And otherwise, you have to leg in with one side of the trade and then leg in with the other side of the trade and try to manage it. It's a nightmare if you're doing this with individual stocks. So that's a real big benefit to trading the E-minis and using ThetaTrader. You can do something like a Dragonfly with one order at one price. And this is just an example of a demo account that was accepting Dragonflies since June or July, I forget. But again, just the idea that just lots of base hits along the way, just doing one at a time here in this demo account. I mean, that's a good streak. And of course, it's not always going to be all winners, but slow and steady is the theme we're trying to instill here or project. So here's how to get started using ThetaTrader. So that includes all the theta trades that we saw on the dashboard, the risk thermal indicator, which is the color coding, and the automation for your risk and profit controls, and then the trade simulator, which is a really great tool. It's a lot of fun to use that as well. Valued at over $3,500 for the ThetaTrader software. And here's the thing, it also includes those one-touch trade alerts. So again, the ease of use, you touch accept or reject, and that's all you need to do. And these alerts are already live and integrated and connected with your trading account. So if you get an alert, you don't have to log into some other third-party platform and try to copy something down. You just touch accept or reject. And then once your trade is filled, you know how the RTI can automatically manage the risk and reward for you. So that's valued at over $4,400 on those interactive trade alerts. So just to summarize, ThetaTrader with the alerts, an over $8,000 value, And then you have us. You've got private coaching available, and we've done events and so forth as well. But we're always available. We can make time available, I should say, not 24/7. But we do these screen sharing sessions with you, and we're all Series 3 licensed and experienced. So we'll do classes with you, and you can kind of tell us what your goals are and so forth, and we'll help you along the way. That's, your best interest is our best interest. We want you to succeed in this and be a client for many, many years. So what's the retail cost of a coaching program? I looked this up again. Private trading coaching, entry level coaching, $2,000 for 3 months. Comprehensive packages anywhere from $5,000 to $15,000. So I don't know. I think the coaching aspect of this is worth at least $10,000 based on what we just looked at. So you have someone who's not only experienced but licensed, and they'll review your trades, discuss your goals and your trade strategy and your approach. So you have the ThetaTrader technology that includes the alerts along with us. You get the private coaching valued over $18,000. And then as a bonus, don't want you to forget, you have our proprietary TradeScope newsletter. I didn't show you that in the dashboard, but just a good example here. It's just usually 1 to 2 pages long. It's a quick synopsis of what's going on in the markets, and then a market outlook, and maybe kind of giving an indication of some of the trades that we might plan, in the near future. And then I did review this briefly, the futures and options masterclass. So the education, that's all within ThetaTrader there. These video chapters here. I think there's 7, is it? Or 6 chapters here. So really everything you need to know. So that's our masterclass for futures and options trading, valued at $1,997. So really you have the research and the education over a $2,900 value. And then we have those online tutorials, and that's really just part of ThetaTrader. Of course, I don't think you really need to use them though, because it's so intuitive and user friendly. You probably won't need to really refer to those often, but they are there. So just to summarize everything, ThetaTrader itself, then the alerts, then the coaching, then you have the research and the education valued at over $21,000. So that's our ThetaTrader professional options trading package. Of course, we're not offering it at that number today. And this is the number we used to use in-person live events. And people would come to the back of the room and have a table set up, and we'd sign up people that way. But we'll do it even less than that. And this is our retail rate on the website. So we can do much better for you in our live webinar today. So it's a one-time payment. It's only $597, and that's a lifetime membership. So there is the link right there, but that link does expire in terms of the discount. So it'll expire by tomorrow evening, I believe. cf.altivest.com /TT. Let me write that in there. And then you've got the QR code there as well. And that's my direct phone number and email if you have any comments or questions. And then you can also get a free membership if you have $100,000 or more with us. After signing up within 30 days, we'll get a 100% refund on that membership. Or $50,000 and above, you get a 50% refund. And then really you have no excuse if you kind of like what you see and you're just a little hesitant. That's okay, because your membership is fully refundable, 30-day money back guarantee. Sign up now, and in the next 30 days you decide for some reason your life takes you in a different direction and you're no longer going to do this, just let us know and we'll just give you a refund on that membership. So real simple, make it real easy. And just a few advantages. I kind of referred to this earlier in the advantages on the e-minis, but they require less capital, so they're affordable. They provide flexibility, so you have that large cap US equity exposure. They're highly liquid, quick entry and exit of positions. and accessibility. So you can expand your trading strategies. And that's kind of what we talked about with the Dragonfly having the 6 legs, and using the E-minis, we can access that kind of strategy. And you don't have to choose from 6,000 different securities and try to figure out what to do with each one of them. um, and then how about liquidity? So the E-mini S&P 500, just that one market alone, it has 2.5 times more in average daily dollar volume compared to all global ETFs. So this is where the activity is occurring, folks, in these E-minis. And that means the options markets are very liquid, 1.5 million average daily volume in 2024. So the CME group has an article here. It says that the ES options can offer superior execution versus SPX options, a cost savings of $4 to $15 per contract. So that's why we love these E-minis, those tighter bid offer spreads. That's what they're referring to. And also trading covered strategies like the way we do it, and what we just discussed. You don't have unlimited risk, and there are no margin calls. That's another big benefit to doing these covered strategies and not doing naked strategies. And there are no day trading restrictions in futures options markets. So if you're not familiar with that, if you're trading securities and you are day trading, then you have additional scrutiny. So a day trader or pattern day trader is someone who executes 4 or more day trades within 5 business days. So once you do that, you're identified as a pattern day trader, and you have additional regulatory scrutiny, and then you have to have 25,000 in your account. And if you fall below it, then you're prohibited from making further day trades, and so on and so forth. So you don't have that um, type of red tape, I should say, with futures options. And there's tax efficiency. There's a big advantage when trading with futures options compared to, say, individual stock options. You have that tax efficiency. And what I'm referring to there is these are classified by the IRS as 1256 contracts. So the gains are taxed, 60% of the gains are taxed at the capital gains tax rate versus 40% at your income tax rate, or your personal rate, I should say. So that's usually a big, big benefit, because the capital gains rate is almost always less than a personal rate. So here's a mathematical example. We're not going to walk through every detail, but tax savings versus individual stocks in this example, over $2,000, just because you're trading with futures options and then futures, rather say trading options on a particular security. And there's no more itemizing. So with futures options and futures, you receive your profit on a 1099, and that's it. You need that. You put that one number and file your taxes. You don't have to do itemizing and wash sales and so forth. But always consult your tax attorney or advisor. We're not experts on that. Just pointing out some of the advantages that we see. And also IRA, we can use a self-directed IRA with you, so you get that tax advantaged approach. And we work with Equity Trust. They have over 71 billion. We just did a presentation with them a few months ago. That was a lot of fun. But they've agreed to set up the setup fee is waived for AltaVest. So you sign up, start using ThetaTrader, have an account with AltaVest, and have a self-directed IRA with Equity Trust, and they will waive your setup fee. So remember too, we are full service brokerage, so we can trade any commodity futures and options market, not just what we saw today. So keep that in mind. If you're interested in some other things too, you can talk to us about that. Anything on the screen there, we trade it if it's a commodity market. So to summarize the benefits of ThetaTrader, these are flexible strategies for any market condition. These are what the pros are doing with premium collection strategies, and we can simplify that for you. The convenience, the automation can save you a lot of time. These strategies can help you diversify or hedge with what we call non-correlation. So if the S&P stock market, broadly speaking, is, say declining a particular amount, the results of your ThetaTrader type of account and trading can be totally different. So everything's not going to be moving in the same direction necessarily. You've got the tax efficiency and the tax advantaged approach to trading. And then those trade alerts, you saw how effective those can be with the one-touch response there. Then there's no pattern day trading restrictions as well. So I know it's a lot of information, and it's time for any questions. And I'll leave this up here for now. But let's see if there's any questions coming in. One question we do get is almost get it. Well, I get it every single time. I'm in Canada, and can I have an account with you? And I would love to have you trade with us, but there are some restrictions. So just contact me directly on that question, and I can answer that for you. We've got clients in a lot of different countries, but there are some restrictions on some countries. So depending where you are, um, a lot of countries saying to you, I should say a lot of clients we've had in, say, Australia of all places, UK, parts of Asia, but just let us know. And let's see what else is there. People want to ask about what size of account they should use. Well, really, it's about you and what amount of risk capital you have and what you're comfortable with. But each Dragonfly typically is about a $5,000 requirement for, like, say, a cash allocation. So keep that in mind. And what else is there? If I see any other questions, let's see, I put that up in the chat for the link. And what else is there? Oh, yes, you have an account with us at AltaVest. So using ThetaTrader means you're using our technology. So as the brokerage firm that developed ThetaTrader, you would have an account with us. Absolutely. All right, well, very good. That was a lot of fun. I hope everyone enjoyed their time and found it productive, but I will leave this up here, and let me put my information in the chat there, my number or my email here. So it's just eric@altavest.com, ERIK at altavest.com. So feel free to reach out with me to me with any questions. And this $597, that's a lifetime membership offer, and that expires tomorrow night, I believe. So love to have you on board. I think you love using ThetaTrader, and you can have access to these professional strategies at the touch of a button. Okay, we'll wrap it up. Thanks, folks, for joining me, and I hope to hear from you soon. Okay, bye-bye.